Hi, Gene. My name is Ed Babtkis, president of Ross Diversified Insurance Services, a national insurance agency insuring real estate for investors the last 31 years.
Okay, where are you out of?
Out of Orange, California.
You're right here. We're taking this today in Orange, California. So this is where you're coming out of, hailing from.
It's right here in my own backyard.
All right. Well, some of the stuff that a lot of investors want to talk about on insurance, it's one of those boring necessities, and so they want to know. They get this property, it's vacant. They want to put force-placed insurance on it. What kind of insurance would they want on that? What kind of insurance to value would they want on that?
There's a couple different ways to approach it. One is you can either insure for the value of your note. The other is to insure for the value of the structure. So I'm just going to take an example where someone is in first position. They have a non-performing note they just bought from whomever, and they go by the property and they find out it's abandoned or vacant, or even if the borrower is in there, it's still non-performing at the end of the day.
Yeah.
Which means the borrower hasn't paid his insurance. If he hasn't been making his mortgage payments, 99% reality is he hasn't paid for his insurance. And the lender or whomever you just bought that note from, their lender-placed insurance cancels the day that their interest ceases. So that property does not have insurance, and it's incumbent upon you to protect your investment by force-placing insurance onto that property.
Okay.
Now that process entails getting set up with someone, no cost with our agency, Ross Diversified, that allows you to cover a property anytime, anywhere in the United States, simply by completing a form that says, I want to choose this amount of coverage, and this is the address of the property, and you get it over to someone like our agency, Ross Diversified. We bind it on the spot, sight unseen.
We can do that by email?
You can do that by email, and we have pictures of sometimes of the property, sometimes we have pictures of the check we're going to get paid with, but it's this application that can just be emailed right over to us.
Is it going to help you if I go to the property or give Google pictures or BPO photographs to you and say, this is the property, this is the condition? Is it better for you?
For lender-placed insurance, it's not necessary at all. Lender-placed insurance doesn't have any underwriting criteria. If you end up foreclosing on that property and it becomes an REO and you convert it to a rental, that's a possibility. But at this juncture, you're a note owner, you just bought the note, it's not performing, there's no insurance on there, you give us the address and the coverage amount that you wish to insure it for, and we'll go ahead and bind coverage on the spot.
Okay. So I've got a borrower that's in the house and they're aggressive. And now this doesn't happen often because you're trying to work it out with them so they can stay in their home. That's our first choice. So these people are aggressive and you're thinking maybe they're going to be doing some damage before they get out of there. So we've got this force-placed insurance on it. Are we covered for them to tear that place up or burn it down?
Great point. If you can document somehow the condition of the property at the time you place the insurance, it's very easy for the insurance carrier or the insurance carrier adjuster to go out and say, hey, this is the way the property was when insurance went into effect. It's now in this condition. Clearly there's a vandalism loss, a malicious mischief loss, whatever the damage that occurs to the property. The easiest example is a fire. If you put coverage into effect October 1 and the fire report shows that the property burnt down October the 2nd, there is no issue as to when that damage occurred. The insurance companies are very clear that they are not on the hook for any damage that occurred prior to the effective date of that policy. And that can get a little bit muddy. I don't want to give you a black and white answer because it's hard. We talked about one example, for instance, in Chicago or in Indiana where you have the basements, and if you have freestanding water in a basement for 2 or 3 months and you have mold going throughout the house, and you put the insurance in place a week ago, the adjuster is going to go out there and he's going to deny your claim because that damage was pre-existing. It was already there.
Yeah.
Whereas again, in the fire example, it's very, very clear. You put the policy into effect on a certain date and the fire occurred afterwards. It is incumbent upon you to show that that claim happened after you put the coverage into effect.
At what point am I legally able to put insurance on a house? What do I need to have?
The moment you're on title, The moment your
I'm on
name
title.
is on title
Or an assignment?
or an assignment,
Okay.
and you're the mortgagee or the owner in the event of an REO, you have an insurable interest in that property, and insurance can go into effect.
Wonderful. Okay.
And we talked about land contracts
Yeah,
for
yeah.
a while. Land contracts are very interesting.
CFDs, yeah.
People are getting more involved in that. It's a nice tool to use to get somebody in the home who may not otherwise qualify because of poor credit, even though they are shown the ability to repay, that the land contract is used. And even if the borrower goes out and gets his own homeowner's insurance, you're still the owner on title. So if someone gets hurt on that property, that liability exposure falls upon you, the owner of the property. So we have a program where we can provide $500,000 of liability coverage to protect the owner of that land contract in that set of circumstances.
Okay, I've got 5 empty properties. Honestly, they're the lot with a house still on it, but I still want to keep them because I've been careful on the type of properties I bought. Sometimes they're commercial properties and they got a house on them and the house is falling down, so I've got to have liability insurance on 5 of them. So can I blanket that somehow?
We have different coverages that we can offer. It may be in your best interest, if it's individually parceled or individually addressed, to have a separate policy per property,
Okay.
depending on the type of structure that's on there. Also, if you own it, we have a separate program aside completely from lender-placed and aside completely from REO insurance, where we insure rentals at very competitive rates all over the country. And that holds true if you're going to take one of those properties and fix and flip it, where we can write a 6-month rehab policy, again, at a very competitive rate.
Right.
So
Right.
that depending on your exit strategy, we may use an REO insurance program. We may use the land contract program we just discussed. We may just do good old-fashioned lender-placed insurance because it's a note that you're trying to get to reperform. Or we may do a fix and flip, or we may do a long-term rental, or even in this day and age, if you turn it into an Airbnb, we have a short-term rental insurance product because that liability is very, very meaningful. It's a very unique coverage.
What type of loan to value coverage? Did we talk about that yet?
Well, you talked about, and I appreciate the question, choosing coverage, and I don't think I answered that. So you got this note, and are you going to cover for the amount of the note, or you're going to cover for the value of the structure? It depends on what your intention is. If that house burns to the ground, are you going to rebuild that structure? You need to ask yourself that question, because if you are, then you want enough money for replacement costs to rebuild that structure to where it was before it burned to the ground. If your intention at that point in time, and you think this through in advance, is no, I'm just going to sell the lot, then you're going to insure the house for that note value, and you're going to get either an actual cash settlement or something that's going to be close to what you purchased the note for. You'll sell the land and hopefully you'll come out ahead. So that's how we advise people how to choose their coverage amount. And that's also how we look at the position, whether you're in first mortgage or whether you're in your second mortgage, because that'll have an impact on that question as well.
Okay.
Other items that come
I'm
up
not-
from an
yeah.
investor's point
Yeah,
of view
talk to me about it, yeah.
that we haven't talked about that we should is what is the first step an investor should take when they buy a note? What's the very first thing that they should do? They should get endorsed onto whatever policy is existing.
Yeah, the endorsement.
Now, we
that's
talked
right.
about non-performing. Maybe there's never been a policy or the previous investor or lender had lender-placed insurance. But what if there is an Allstate policy out there, or a Farmers policy, or one of the major carriers?
How do I buy this note and find out if there is insurance on it if
Well,
the borrowers went dark?
If the borrowers go dark, it's hard. It depends what's
Okay.
in that file that you get from that previous lender.
Okay,
That
gotcha.
hopefully there's some clues in there. If the borrower is dark and there's nothing in the file, then you have to assume it's not covered and you have to lender place. If you find out there's a policy later on, then we can always cancel our lender place policy and you get a refund for it.
Go back, okay,
But
right.
you don't want to leave yourself exposed.
Yeah,
Better to pay for the policy and get the refund than not pay for the policy and have the place burned down and have no coverage. But If there is a Farmers or a State Farm or Allstate or a major insurance carrier on there, then you want to get what we call a lender's loss payable endorsement. And what that says is you now have the rights as a mortgagee so that if there's any claim on that property, your name is on that check equally with the borrower's name.
So
the
if
borrower
I'm looking
can't.
through my file,
Yes.
I look through my file, I find an insurance policy in there.
Yes.
I don't know whether it's live or dead, but I found an insurance policy. So I can take and get on the internet and get a form. What's the name of the form?
A lender's loss payable endorsement.
Lender's loss payable endorsement form, and I fill that out and I send it to these people that I found that.
Right, you can send it
Notice
to the
the
agents
insurance.
on the Allstate agent or the State Farm agent or the home office. Do it with your assignment so that they
Progressive,
see
whoever
you're
it
on
is,
title.
right.
Whoever the insurance company is. Substantiate why you're making this request. Yes, I am on title. Here's my document.
How do I find that? Do I just Google that?
You
for
can
that form?
you can Google lender's loss payable endorsement, and that form will pop up in 15
Lender's
different
loss
ways.
payable endorsement, and that form will pop up.
It'll pop up.
Okay, that's good. That's good information.
Yeah, well, we want you to have the right apple for what you're trying to
Sure.
accomplish at
Well,
the
I ran
end of the
into
day.
that. That's why I'm like, hey, this is okay.
And you can always call the borrower if the borrower has not gone dark. Do you have an insurance policy? Great. Who's the agent?
Yeah.
Then you go ahead and contact the agent, and the agent will make that process happen smooth as silk because the agent wants that policy to stay in force and keep renewing it. So that's always your easiest path of least resistance if you can find it. If not, then you have the lender's place policy to use. And if it becomes REO, then you convert the lender's policy to an REO policy because that has the liability. And it's important if you become the owner of the property that you have liability insurance on there to protect in case someone gets hurt on the property. If you're in
my
second,
phone rang and it threw me off here a little bit.
if you're
What-
in second position, what we recommend is look at the equity structure. If you have a $100,000 home, and the first is a tiny first at $10,000 or $15,000, and your second is $50,000, then you should really think about lender placing or force placing. I use it interchangeably because lender placed and force placed are used interchangeably.
Okay.
You should force place for the amount of your second mortgage because the first is so small. Conversely, if you have a $10,000 second and the first is for $90,000 and the house is worth $100,000, you may not need to do anything because the first is going to drive the whole equation in the event of a fire claim.
Is that right? Okay, I buy this note. I'll give you a real example. I bought a note for $15,000.
Right.
But the property was worth $84,000. So I got lucky. I just happened to hit the right buttons. And so the property's worth so much more than what I purchased it for. I didn't insure it for the price of the note. I insured it for, I think, $65,000. So, do you have a recommendation for something like that? What would you do?
You know, we touched upon it, and again, here's the thought process. Before the fire occurs, right, you just bought this note, would I rebuild this property if it burns to the ground? Or would I just walk if it burns to the ground, sell it for land value, and maybe get some small insurance proceeds? Here's the thing people have to remember with fire insurance, and it doesn't matter if it's your homeowner's policy or if it's lender's placed. It does not matter. You're going to get the amount of that policy, up to the amount of that policy, only if you rebuild. If you don't rebuild the property, you're going to get actual cash value. And what that means is the insurance carrier holds back depreciation. So on an older home, they're going to hold back a big chunk of money. They're happy to pay it out as long as you rebuild. If you don't rebuild, it's a windfall for the insurance company. So before you ask yourself that question, how much am I going to insure for, the first thing you have to ask yourself is, would I rebuild this house if it burned to the ground? Because if you're going to take an actual cash value settlement, then there would be no point in your example to insure it for $84,000 or perhaps even $65,000 if it's an older home. Maybe only insure it for $20,000 because that's the actual cash value, and you have no intention of rebuilding.
Okay.
So you have to ask yourself that question, and then that answer will lead you to the amount of insurance coverage that you should put on that property.
Okay. You got anything else to add? I'm kind of out of questions for right now.
You're asking all the right questions. What we try to do is bring some awareness. Don't assume you're not going to have the fire. Don't assume it's something you can put off to the side because you got so many other things on that note that you're concerned about. You should have a program available so before you close on that note, you know if you're going to have to lend or place or not.
Okay.
You have that vehicle already set up so that you know the moment you send your wire, and now you're the mortgagee, at that moment in time, you should either be endorsed onto someone's policy or you should lend or place, not a week later. Because in that week's time, if something happens to the property, it's your money that you're going to be out of.
Okay, and the insurance company is like, hey, I just wired this money off. I got to get this note handled. And the insurance company doesn't bother them at all.
Not at all, not at all. We do the lender placements. It's totally fine. The one thing we didn't touch upon, and shame on me, with Irma and with Harvey, is the flood insurance that's going on, that we're seeing the damage in Houston. And I'm going to talk about something that I could talk forever about, but I'll do it in about 2 minutes just for the sake of conciseness and keeping the audience's attention. If the water comes from the ground on up, 90% of the time that's flood insurance. Flood insurance is not counted, not included in your homeowner's policy. It's not included in lender's placed insurance. Okay. You have to have a separate flood insurance policy in order to pay for that type of damage. If the damage occurs from the roof on down, the wind damage that we're seeing with Irma in particular, and in some of the homes in Houston, that is covered. That's covered under wind, and the rain that comes into the property is water damage, and that is covered under a lender-placed policy, and that is covered under a traditional homeowner's policy. So again, the easy way to think about it, if it's from the ground, entering into the house, coming on up, that's flood insurance.
Or upside down.
And I'm not covered unless I have a policy through the National Flood Insurance Program or something like that.
Okay.
Or it's coming from the roof, and that's probably a little bit better because then I am covered under the homeowners or under the lender-placed policy.
Well, they had both things. They had the rain coming from the roof, and they had water coming up from the bottom. So they needed both of those, basically. Is that what you're saying?
That's what I'm saying. And in the case of Harvey, unfortunately, you saw the people wading through the water. You saw the people getting picked up on boats. You saw 53 inches of rain in 24 hours, just in a phenomenal amount of water. That's flood damage. That's flood insurance. And if you don't have flood insurance, you're going to be SOL. It's not going to be a pretty picture. The damage so far that I've been seeing with Irma in Florida, a lot of that damage is coming from the roof on down. The wind speeds were so dramatic that it was blowing the roofs off of homes, and the water coming in was rain, and therefore you had the water damage, and it was a direct result of the wind, and therefore you are covered.
Interesting.
So that's the easiest way to conceptualize that without splitting too many hairs.
No, I think that's great.
Too many
Personally, I didn't have
know?
it put together like that. So, yeah, okay, all right. So
be aware when you buy that note, know in advance what the repercussions may be as to insurance so that you have your vehicle set up so it's just plug and play. It's not a whole lot of thinking, and you can always get a refund after the fact. So we encourage everybody, and whether it's through us or any of our competitors, we encourage you to, you just spent $60,000 on a note, or $25,000 or $42,000 or whatever the math is for the $700 for insurance. Don't be penny wise and dollar foolish.
Yeah.
Buy the policy knowing you can cancel it a month later once you sort out the insurance. Don't do it the other way around, because if something happens, you're out of luck.
yeah, insurance policies don't really, they don't cost the grief. Cost of grief is like, it kind of outweighs itself. So.
Yeah, no, insurance is like getting a tooth pulled. No one likes paying for it, myself included, but it's something that you got to do. It's something you got to do.
All right. Well, thank you very much.
Thank you. Appreciate it.